Something extraordinary just happened in the silver market. After being closed for 9 days, Shanghai reopened, and within hours, it exposed one of the largest pricing disconnects we've seen in modern silver trading. Because while Western spot silver was trading near $86 per ounce, Shanghai opened physical silver at $99, not 90, not 92, 99. Within the same session, silver in Shanghai surged as high as $102 per ounce. Let that sink in. $102 for the exact same metal, the exact same element, the exact same ounce of silver. And while Western paper markets were still trading in the mid-80s, physical silver in Shanghai was clearing nearly $10 to $16 higher. By the end of the session, the average closing price was around $96. But reports indicate that the final physical lot of the day still cleared at $102. That means real buyers with real capital were willing to pay triple-digit prices, while Western futures markets were still pricing silver far lower. This is not a minor discrepancy. This is not normal arbitrage noise. This is a structural disconnect between paper pricing and physical demand. And it confirms something critical. The signals coming out of China before Shanghai reopened were real. In the days leading up to this reopening, recyclers and physical dealers were already bidding aggressively above Western prices. Many dismissed it. Many assumed it was temporary. Many assumed Shanghai would reopen closer to Western spot. That did not happen. Instead, Shanghai reopened and immediately validated those higher physical bids. It proved that physical demand did not disappear during the holiday. It intensified. Because when the exchange finally opened, buyers stepped in immediately. They did not hesitate. They did not wait for lower prices. They paid the premium. Now think about what that means. For 9 days, Shanghai was offline. During that time, Western paper markets drove silver sharply lower. On February 17th, silver was pushed down to approximately $72 per ounce. That move happened on thin liquidity, during a period when one of the largest physical buyers in the world was completely absent from the market. There was no Shanghai participation, no Shanghai demand, no Shanghai price discovery. Paper markets moved without the presence of physical buyers from the east, and when Shanghai returned, it immediately repriced silver higher. Not gradually, not cautiously, immediately. This is what happens when physical demand returns to a market that was previously driven by paper positioning. It forces repricing, because physical buyers do not trade charts. They trade necessity. They trade inventory requirements. They trade supply security. And when supply is uncertain, they secure metal at whatever price is required. But here's where things become even more important. Despite Shanghai's explosive reopening, Western silver prices did not immediately follow. Instead, Western silver approached a critical resistance zone between $87.20 and $89. This zone had already been identified as a key technical barrier. And when price reached it again, it was rejected, not once, not twice, but 3 separate times. Each attempt failed to produce a strong hourly close above that level. Each attempt was pushed back down. Each attempt confirmed that this zone is still acting as resistance. As of now, Western spot silver has fallen back below that zone, trading around 86.40. This tells us something essential. The physical market and the paper market are not moving in sync. Shanghai is trading near the mid-90s to low hundreds. Western futures remain stuck below resistance. This divergence cannot persist forever. Eventually, one side adjusts. Either physical demand weakens, or paper prices rise to match physical reality. But until that adjustment happens, this gap remains one of the most important signals in the entire silver market. And this is where technical structure becomes critical, because resistance is not broken by accident. It is broken by force. A true breakout requires a strong hourly candle body, closing above $89. Not a wick, not a brief spike, not a momentary move, a confirmed close, because without that confirmation, the resistance remains intact, and traders continue defending that level. For now, the tape is telling us that resistance is still holding, but pressure is building, because physical demand is not disappearing. Shanghai already proved that. And when physical demand continues pressing against paper resistance, eventually, something gives. Now, layer on something even more alarming. Silver's implied volatility index, known as CVOL, has surged to 134. Just days ago, it was barely above 100. Now it has exploded higher. This matters, because implied volatility measures expected movement, not past movement, future movement. When CVOL rises this sharply, it means options markets are preparing for violent price swings, moves that are larger, faster, and more unpredictable. What makes this especially unusual is that volatility is rising while price appears relatively stable, normally. Volatility spikes after price moves. Here, volatility is rising before the move fully happens. That creates tension. because suppressed price and explosive volatility expectations cannot coexist indefinitely. Eventually, price must move to resolve that imbalance, and historically, when volatility rises during periods of physical shortage, price adjustments tend to be rapid, not gradual. And then something else happened, something that confirms stress inside the system itself. The Shanghai Futures Exchange suspended 23 trading accounts in a single month, 23, for violating trading rules. This is not speculation. This is documented enforcement action. Exchanges do not suspend accounts casually. They do it when activity disrupts market stability, when trading behavior violates rules, when manipulation attempts are detected. This confirms that Shanghai itself experienced abnormal trading conditions during reopening. It confirms that the reopening was not calm. It was contested, volatile, and heavily fought, which makes sense, because when physical demand surges and paper positioning is vulnerable, the opening becomes a battleground. And all of this is happening just days before one of the most critical deadlines in the silver market. COMEX first notice day, the day when futures contracts transition from financial instruments into potential physical delivery obligations. And that is where the real pressure begins. Because once delivery begins, paper positions must be backed by metal, or closed, or transferred. In part 2, we'll break down the delivery math. The 188 million ounces of paper claims versus only 88 million ounces of registered silver. Why backwardation could signal a physical supply crisis. Why volatility at 134 is a warning signal. And why the gap between Shanghai and Western markets may be approaching its breaking point. Because what happens next will determine whether silver remains a paper-driven market or transitions into a physical-driven repricing. Now the clock is ticking. Because Shanghai's explosive reopening didn't happen in isolation. It happened just days before one of the most important deadlines in the global silver market, COMEX first notice day. This is the moment when futures contracts stop being theoretical and start becoming physical obligations. It's the moment when traders who sold silver contracts must decide, will they deliver real metal or exit their positions before they are forced to? And right now, the numbers behind that decision are creating one of the most fragile setups in years. As of the latest data, there are approximately 37,651 March silver contracts still open. Each contract represents 5,000 ounces of silver. That means roughly 188 million ounces of paper silver still exist inside the March contract. 188 million ounces. Now compare that to the amount of silver actually available for delivery inside COMEX vaults. Registered silver inventory sits at roughly 88 million ounces. That's it. Which means there is roughly 2 ounces of paper claims for every 1 ounce of physical metal. And that assumes every ounce of registered silver is actually delivered. This is not a comfortable margin. This is a tight system. And tight systems become unstable when demand increases unexpectedly. Because if too many contract holders stand for delivery at once, the exchange must find metal quickly, or convince participants to settle financially instead, or change contract dynamics. That's why the days leading into first notice are so critical. This is when the system is tested. Now here's where the Shanghai premium becomes extremely important. Because Shanghai just showed the world something unmistakable. Physical silver was clearing near $96 and even $102, while COMEX contracts were still trading around $86 to $88. Think about that from the perspective of an industrial buyer. If you are a solar manufacturer, an EV producer, an electronics company, and you need physical silver for production, you now face 2 choices. You can roll your futures contracts forward and hope prices stay stable, or you can stand for delivery now and secure metal below Shanghai's physical price. That creates a powerful incentive. Because if physical silver is already trading higher elsewhere, taking delivery now locks in supply at a relative discount. This shifts behavior. Instead of rolling contracts forward, more participants may choose delivery. And when delivery demand increases, pressure on inventory increases. And when inventory pressure increases, price adjustments often follow. We've already seen warning signs of rising delivery demand. In February 2026, nearly 98% of open silver contracts resulted in delivery. That is an unusually high percentage. It means almost everyone who held contracts chose to take the metal instead of rolling forward, instead of closing positions. They wanted physical silver. And in January 2026, COMEX delivered approximately 49.4 million ounces. That was more than 7 times higher than January just 2 years earlier. 7 times. That kind of acceleration is not random. It signals changing behavior. It signals rising demand for physical metal. It signals declining trust in paper exposure alone. And it signals that participants increasingly want ownership, not just price exposure. Now imagine that behavior continuing while inventory remains limited. if only 20 million ounces are demanded. COMEX inventory drops sharply. If 50 million ounces are demanded, inventory could be cut nearly in half. If delivery demand climbs toward 80 million ounces, the entire structure faces extreme stress, because the system was not designed for every contract holder to demand metal simultaneously. It was designed assuming most contracts would settle financially. That assumption is now being tested. And there's another signal quietly approaching: backwardation. This is one of the most important stress indicators in commodity markets. Under normal conditions, future contracts trade at slightly higher prices than current contracts. This is called contango. It reflects storage costs, financing costs, time value. But when the opposite happens, when near-term contracts trade higher than future contracts, that's backwardation. And backwardation sends a very specific message. It says the market values metal today more than metal tomorrow. It says immediate supply is more valuable than future supply. It says buyers need metal now, not later. Backwardation does not happen frequently in precious metals. And when it appears, it often signals supply stress. Right now, silver is approaching that threshold. Not fully confirmed yet, but close enough that traders are watching carefully. Because if backwardation appears, it confirms that physical demand is overwhelming short-term supply, and that can trigger rapid repricing. Now step back and look at the broader pattern. Shanghai physical silver clearing as high as $102. Western paper silver struggling below $89 resistance. COMEX holding only 88 million ounces against a 188 million ounces of paper claims. Delivery demand rising dramatically compared to prior years. Volatility exploding to crisis-level readings. Trading accounts being suspended in Shanghai due to abnormal activity. All of these signals point to the same underlying theme: stress, not visible on every chart, not obvious in every headline, but present beneath the surface, because markets remain stable until suddenly they aren't, until supply and demand imbalances reach critical thresholds, until physical reality forces price adjustments. But it's important to remain objective, because volatility cuts both ways. Shanghai opened at 99, hit 102, but closed near 96. That means sellers still exist at higher levels. It means price discovery is ongoing. It means the market is still searching for equilibrium. Volatility at 134 means moves can happen in either direction. Sharp rallies, or sharp corrections. Nothing moves in straight lines. Even the strongest bull markets experience violent pullbacks. And even the most compelling structural trends unfold over time, not overnight. Timing remains uncertain, structure remains intact, but resolution takes patience. There is also the possibility that Shanghai prices stabilize rather than continuing higher immediately, or that Western paper markets resist upward movement temporarily. Large financial institutions still hold enormous influence. Liquidity events in other markets could temporarily pressure commodities. Short-term volatility could create false signals. This is why discipline matters, because emotional reactions often lead to poor decisions, while careful observation leads to clarity. But one fact cannot be ignored. Physical silver and paper silver are not telling the same story right now. Shanghai paid nearly triple-digit prices. COMEX still trades significantly lower. Inventory remains limited. Delivery deadlines are approaching. Volatility is rising. And the gap between physical and paper pricing remains open. History shows that gaps like this do not remain unresolved forever. They close, sometimes gradually, sometimes violently, but always eventually. So now the key question becomes simple. Will paper markets rise to match physical demand? Or will physical demand temporarily retreat to match paper pricing? The answer will emerge through delivery data, through inventory changes, through volatility behavior, through the actions of buyers and sellers in the coming days. Not opinions, not predictions, data. Because in the end, markets reveal truth through price. And right now, price is sending one of the most important signals silver has shown in years. The next few sessions may determine everything.